Good morning, ladies and gentlemen. This is Robert Rayburn from Life Pro Asset Management. I am joined by our head financial planner here, Tim Devlin, also of Life Pro. Tim, say hi to the audience.
Hey, nice to be here. Back again for a third week.
Well, that's great. And we're going to be doing this week in and week out. And, I think that so far what we've heard from you, the audience, whether you're an advisor or a client or prospective client, is that you really do sort of appreciate the more conversational tone. And I think more specifically, kind of going through some of our Bloomberg charts on the fly and really kind of getting to the details of the portfolio, which, when we look at what's going on in the markets this week, that could not be more relevant. And when we go through stock market corrections like we are this week and the week prior, that's when we have to be more engaging. That's when it's our job as a portfolio manager, as an advisor, as an investor, to walk our clients through what's really going on. What is noise? What is substance? And where are there opportunities and risk? And really, to kind of sum up, Tim, really what this current correction reminds us of is really that move lower that we saw at the end of January, or sorry, not the end of January, the end of December, where we had about a 10, 11% pullback. We then had approximately about a 12% or 11, 12% pullback just right around the election. We actually had two separate corrections in and around that end of October, beginning of November time period. For those clients that have been with us, you will remember that time period. And then, of course, September, which was a little bit deeper. We had about a 13 to 14% pullback. This reminds us more of September. Right now, we've had around a 13% pullback off our high water mark in terms of our strategy. That is a completely normal investment experience as it relates to our strategies. When we look throughout time, over the last year, we've probably had 6 to 7 of these types of pullbacks on our way to reaching various high water marks throughout that investment experience. Has that generally sort of been your experience as well, Tim?
Yeah, it is. And, we're going to take a look and kind of dive into the data behind that today. And I know every time this kind of comes around, one of the things that always happens is we get client calls. And what we do is walk them through that asset allocation, right? The importance of having some short-term money versus long-term money to kind of help you through these, corrections, right? They're going to happen. But the value long-term, you got to kind of get through them, right?
Well, that's exactly right. Because remember, ladies and gentlemen, what we're doing is we're investing in long-term secular growth. We're investing in specific companies that are building and accumulating enterprise value, capturing market share, growing sales, expanding margins, dropping those revenues down to the bottom line in the form of retained earnings, and then reinvesting that back in the business so they can ultimately capture market share. All that sounds great. But over short-term time periods, you will see these stocks reset, and you need that. It's healthy. That's what creates sustainable long-term bull runs. When stocks just go up every single day, that's when you can get sort of the bubbly nature that markets can rock themselves into, and we don't want that. So this, believe it or not, this is a really good development. It's painful in the short term because you see the headlines, you see your accounts, and it's never fun to see your accounts go down in value. If you enjoy that, then there's something seriously wrong with you. But I think that over the long run, this is exhibiting a healthy nature in terms of the way that markets are functioning. So real short term here, what we are seeing is a rotation into what we call those reopen trades, right? So like the airlines, the casinos, the cruise liners, the banks. One of the things I will say is that fundamentally, all of these sectors are highly competitive, low margin, and poised for disruption or getting disrupted. And we could ultimately go and try to chase returns in the very, very short term in those areas of the market, but we're not creating a lot of long-term value for clients. And that's sort of like picking up pennies in front of a steamroller. And we're not going to do that. And I will promise clients right now, you will never ever see us invest like that. We're staying focused, laser focused on companies that meet our fundamental objectives. And that's what's ultimately created the returns that you've seen and enjoyed if you've been an investor with us over the last 12, 24, 36 months in and beyond. But let's go ahead and get started. So Tim, can you see my screen here?
Yep, I can see it.
Awesome. And you can see there it says markets are correcting now what?
Yep.
Awesome. Okay, so ladies and gentlemen, what we're going to do today is we're going to go through a playbook. And it's easy to say that corrections are easy and just close your eyes and hope for things to be higher in 6 months. But the reality is we have to have a playbook, and we have to go through stock market corrections in a productive way. We want to understand where is there opportunity when markets correct. As valuable merchandise goes on sale, what are the specific assets we want to look for? But then two, the playbook differentiates between whether we're a new client, we're an existing client, or a prospective client. So we're going to kind of walk through sort of those three types of either existing, new, or prospective clients that we have, and how you should approach market corrections if you're any of those, if you're in any of those situations. The second point is the most important point, ladies and gentlemen. The strongest returns that our clients have enjoyed when investing in our strategies or the overall market, doesn't have to be our strategy or the overall market, is when you're putting money to work during stock market corrections. The clients that have realized the worst returns in the market, so forget our strategies, just the market in general, are those clients that panic, sell, then return back to the market a few weeks later. And it has a devastating impact, and we just have to learn to ignore the noise of the market over the very short term. And we're going to walk through the data that sort of proves this approach out. And then lastly, we are going to go through some of our top holdings just so we can kind of show that, show what the charts look like, where we are fundamentally, and what that fundamental line from left to right looks like for a secular growth company versus some of these stocks that are rallying today in the reopen trade. Real quick, in terms of the performance, one thing that we have promised as a firm from day one is that we will always give performance updates in good, bad, and ugly markets. And so right now, we're going through a stock market correction. More specifically, we're going through a correction in growth leaders as the market has, in the very short term, rotated toward the reopen trades. What has that meant for us? Year to date, we're down 4.3%. We were up 3% last week. And I think anyone that's invested with us would see that obviously we've had a reset in those values. But I think here's the absolute most important point. Tim, where do we rank amongst all other sort of growth strategies in the country when we look at our performance over a 1-year period on Morningstar?
Yeah, we're at the top.
And I think that's the important point there, ladies and gentlemen. When we look at that 1-year number, we're up 91.2% versus 27.18% for the S&P 500. When we take that back to inception, we're up 213.46%. We've grown 213.46% versus 70% for the market, generating outperformance of 142.85%. All stock market corrections, when they are growth rotations out of growth and into more cyclical assets, we're going to underperform, and that's okay. It would be weird if we outperformed during every micro time period. And so we're going to have these periods. We had that in September. We underperformed in the month of October. We underperformed in the first couple weeks of November. That's okay, because guess what? When you're patient and you stay focused on best of breed companies, these are the returns you ultimately are able to generate. And I think that's really the important point from this week's update. Now, we talked about that investor playbook. We have 3 core types of clients that we focus on, right? We have our existing investors, right? We love our clients. When we look at our low churn rate, when we look at realized returns of our clients versus the returns generated by our strategies, our clients are so incredibly disciplined. They are intelligent. They're looking at stock market corrections right now and they're saying, how can we take advantage of it? And so for a lot of our existing investors that have been with us for 6, 12 months or longer, they're even with this recent 10% pullback, the reality is they're sitting on lots of gains. And so they're looking at things in an opportunistic way. Now, for our new clients that are out there and watching this stock market correction, in particular the correction in our strategies, I feel your pain. I do, like, there's nothing worse when you switch strategies and immediately what happens, you get a correction. It sucks. There's nothing, there's no bones about it. But the question is, how have other investors that invested with us prior to stock market corrections, how have they fared over the last 12 to 24 months? And we're going to walk through those numbers, and I think you'll be rather impressed as to, in terms of what those results have been. The reality is we want to look at how long does it take to recover that loss, and then secondly, how long does it take to get to new highs? That's the important point. Do the investment strategies that you're currently in, have they hit new highs after every correction? Or, and this would be more concerning, are we reaching lower highs, right? So we rally, we sell off, then we rally, but to a lower point from the prior high, then sell off again, and then rally to another lower high. That would be very concerning action. And the good news is that is not something that has taken place in our strategies. And then obviously for prospective investors, stock market corrections are the absolute best time if you're looking to switch your investment strategy. When you look at over the last 3 or 4 years, we've had so many clients being an index fund that has underperformed, and they want to realize a little bit more opportunity that the stock market has to offer. If you have a 3-year plus time horizon, I think our strategy now is this is an absolutely fantastic time to put money to work. Wouldn't you say, Tim?
I would agree. Yeah.
So, Tim, why don't you go over this slide? This was a great slide, ladies and gentlemen, that Tim put together, and it really kind of walks through the last few drawdowns that our strategy, not the market, but that our strategy has realized, and ultimately that time to recovery and the return realized if you invested just before a stock market correction.
Yeah. So one of the things we wanted to do is, we've been saying kind of throughout this review is this happens with our strategy, right? So we took a look at the past 6 drawdowns, and these are in order of most recent to oldest here. We looked at what happened if you invested in the previous high the day before, went through that trough and recovered, right? So back in December, the 22nd, we had about a 10% drawdown, 10.52%, and it took about 30 days to recover. Well, one of the things we wanted to look at is what happened if you invested the day before that drawdown. In other words, the worst possible time you could have begun investing with
Yeah.
us, right? Well, had you invested on 12/21, you would have reached a new high water mark with us at 215 for about a 5.86% return. And this kind of plays itself out through each of our drawdowns. One of the things you'll notice is this return percentage on the right is the longer you're with us, the longer we've seen value be created over time. And obviously that's the goal, but it doesn't always get done, right? So it's good to see that our clients are receiving that return, that value over time is being increased the longer you're in that strategy.
Yeah, that's a great analysis, Tim. And I think there's a few points here that I want to really kind of hone in on. So, ladies and gentlemen, first of all, market corrections are frequent, they're normal, and they're healthy, right? They're painful when it happens, but they're healthy. If we look back over the last year, we've had, what is it? Let's see, 1, 2, 3, 6, 7 painful market corrections, right? And each one is, when it's happening, is the most painful that it's ever felt, because it's happening now. It's happening in the present. When we look in the past, we say, oh, wow, we got through it. And certainly a lot of those reasons for the selling were silly, but it's that most recent one that's always the most painful. And if we look back that the brutal sell-off during the COVID-related shutdowns in March, there was a 36% drawdown there. Imagine if you had, and we had clients, and I got to say to those clients that invested with us last February, we are forever, humble, and we owe so much to you because you stuck with us through that tough time period in March of 2020. But it paid off. That patience paid off. So for those investors in March of last year that experienced that drawdown, that we are not experiencing anything like that this time around, just to be clear. But for those that experienced that drawdown, look at what happened. They're up over 100% as of mid-February before this recent correction. They were up over 100%, and now I think up around 90%, even though their timing was terrible, where they invested right before COVID hit the United States. So I think that's an important point, ladies and gentlemen. Most of these stock market corrections are going to range anywhere from 9 to 15%, and the days to the new high after the correction's over also tends to be rather shallow, anywhere from 17 to 30 days. Even that brutal sell-off in March of last year, it was just 54 days until we reached a new high in our strategies. So I think, again, this is a very, very important slide. What we do during stock market corrections ultimately determines our level of long-term success. What am I doing with my portfolio, Tim? I'll tell you what I'm doing with my portfolio. I'm doing absolutely nothing. In fact, if I've done anything, I've actually bought some more Ethereum, which we'll go through here in a bit in my portfolio. But I think that for clients that have seen some Ethereum assets introduced into the portfolio over the last couple of days, that's a sign of where we think things are going. Is that if we look at some of those crypto assets, they were the first to sell off before the broader market. And we certainly don't look at crypto assets as a leading indicator in terms of price action, but that was the first sector to really area of capital markets to experience a sharp sell-off. They've actually been recovering pretty strong here since Friday of last week. So when we kind of think of the rolling sell-off that we've been experiencing over the last week, I think we're starting to see the first signs that the first hit are now the first that are starting to recover. And that's usually a good sign. And there's other signs out there, and we'll go through that I'm actually more confident than ever that I think we're in the 8th and 9th inning of this sell-off.
And Rob, if I could add one more thing on this
Sure.
slide here, I think going back to your existing investor playbook, if you have cash on hand, this is the time to be opportunistic, right? I think this really highlights, while it's hard to buy when markets are down, the forward returns are often very good.
They're the best. We know that for a fact. We know that when you invest in stock market corrections, there's no mathematical ifs or buts about it, that your forward returns are higher than people that put money to work in strong markets. There's just no bones about it. When you're investing, when valuable franchise merchandise is on sale and you dollar cost average into those assets long term, you are generating better returns. There's just no ifs or buts about it. And so I think that's an excellent point, Tim, and something that we always want to encourage ourselves as, as I say for my family and yourself, our employees and our investors and advisors that are investing throughout this time period. So, and this market correction, ladies and gentlemen, is no different than any other correction. We just like to always make sure that we're walking through the reasons why there's noise, especially on a day like, well, I guess today, but it'll be yesterday when our audience sees this recording, where our strategies were off a lot yesterday, and it's a painful day. And so we always want to make sure that we're walking clients through what's noise, what's substance. And I can confidently say a lot of this is noise, and it's being generated by the sell-off that we're seeing in the treasury market. So I'm going to pull up my Bloomberg chart here real quick, Tim. And what I want to do is show my Bloomberg screen. So can you see my Bloomberg screen here?
Yep, you got it up.
Okay, and you can see me typing in that 10-year yield.
Yep.
Awesome. Okay. Still getting the hang of this, ladies and gentlemen? Okay. So what have we seen here over the last couple of weeks? A big move upward in the 10-year yield. Now, a lot of the times when we go through an economic recovery, a rising yield is a measure of reflation, right? Hey, the recovery is taking place. We're moving out of safe assets into risky assets. This should be a reflection of health. What's really got markets worried here over the last couple of weeks has been this strong upward velocity that yields have taken really over the last 2 weeks, where we've suddenly gone from 1 to 1.5 in a heartbeat, right? And that always concerns very short-term traders, right? Because people like asset prices to move in an organized fashion. When things get disorganized or suddenly jolt upward or downward, that has a domino impact across the capital markets. Now, if you're a long-term investor, this is noise, it's garbage, don't worry about it. If you're a shorter-term trader, then you have to really understand why it's moving that way, and is it really the start of a broader trend? And unless it's the start of a broader trend, you can also ignore that as well. And what we see here is this looks obviously as a violent move, but let's really introduce some reality into this, Tim. In 2019, in December of 2019, we were at almost 2% 10-year yields and a healthy bull market. Now we're at 1.48%. This gap is just the gap caused by COVID. All we're doing is we're filling the gap. As we get past this gap and back toward that 2% level, you're going to start to see yields taper off. In fact, I actually suspect you may see yields start to taper off in and around this 1.5 mark. We're very, very overbought. As we can look here on the RSI, we've been in this significantly overbought territory for a long period of time. It's happened a few other times throughout history. So if we pull back 5 years on the 10-year yield, we see every single time, and I'm going to actually move our little zoom guy here. So every single time we've been overbought in this condition, we've had a nice pullback in yields, whether it's been right here. We go back into this time period, that was actually the start of a broader trend downward, or even up here. So a lot of times markets just get ahead of themselves, and the reality is money is cheap. We're talking 1.48%, ladies and gentlemen. When the best way that I can illustrate how cheap money is to show you the max chart. This is the yields going all the way back to 1962. If we had not had COVID, we would be at all-time lows. I just want to really illustrate and press home that point. If we had not had COVID, 1.48% would be a record low for the 10-year treasury yield. So that's why we have to take a step back and say, okay, is this really a detriment to growth assets because growth takes place in the future and therefore we're discounting that growth at a higher rate? Of course not, ladies and gentlemen. Companies that are leading long-term secular growth are going to do well regardless if we're at 1.48%, 2%, or 1%. It doesn't matter. It only matters for those people and investors that are not investors, traders that are concerned about 1 to 2 week moves in the market. We're not those people. If people are looking for that type of strategy, there's strategies out there like that, but they're not generating the returns that we are. And so, that's really something. A picture says 1,000 words, and that, I think, perfectly encapsulates where we are in terms of the cost of money. Now, in terms of secular growth, as everyone knows, that we really focus on companies that are positioned to dominate long-term growth, capture market share, increase margins, and ultimately generate excess free cash flows. Now, if we think of what does secular growth over the long period of time look like? Well, it's going to look like this chart. Now, can you see my chart? I always have to check with Tim here as we're getting the hang of this. Okay, so this chart may look familiar. We talked about this last week. And really long-term secular growth is this upward trajectory of a company accumulating and building enterprise value upward and to the right. Now, is it a straight line like this? Of course not in reality. It's more like this squiggly line upward and to the right. We go through zones of overconfidence, right? So when we think of last December, November, the back half of November, when everything was flying upward, I'm sure everyone felt great about their accounts. And then when you go through stock market corrections, you enter this zone of self-doubt about these individual stocks. It could be Zoom, it could be Amazon, it could be Apple, Tesla, whatever it is, right? And the reality is it's an ebb and flow on its way from negative momentum to positive momentum. And we always undershoot and overshoot the long-term fundamental trajectory. Now, that's an important point because the next chart I'm going to share here, and I think it's an important point, is we're going to look at the long-term chart of Amazon. We don't own Amazon, just for fair disclosure here. We do not own Amazon, but I think it's just a very important chart to look at in terms of a company that has built value upward and to the right, but over many, many years, how many investors really realize the full value of Amazon? Or how many investors bought and sold Amazon 20, 25 times and probably only realized 10% of the overall accumulated growth that Amazon has delivered to their investors? The bottom line is it's probably 10%. I can't say that I did it myself, right? And it's, as a younger investor, it was a true learning lesson for me. And so what I'm going to show here is how many times Amazon has had these corrections, right? We look through here. Whoops. Always the challenge of doing things live. But you can see here, we had a 19% correction in the price of Amazon. Then from here, we had a 35% correction in the price of Amazon. Here, we had a 25% correction in the price of Amazon. Here, we had a 17% correction in the price of Amazon. Each time, think about this, ladies and gentlemen, the price is going down because people are selling. Meanwhile, that long-term value and enterprise value trajectory is just going upward and upward and upward to the right consistently. And here's even the funnier part. Who is one of the most obvious winners of COVID? Well, it was e-commerce. Well, let's take a look back to that March time period. So Amazon went down 25%, even though the company was selling much more widgets in March than they were in February or January. And so this is just a great example of this is stock market noise. Meanwhile, the value line was really going like this, right? This gap represented the opportunity to price or to buy valued merchandise that was deeply on sale. So I'm going to go back to our update here. Now, in terms of the overall market trend, and I guess I have low disk space. In terms of the overall market trend, the other question we get, is this 2000? And the reality, of course, is that it's not 2000, Tim. Ladies and gentlemen, a picture says 1,000 words, as I always say, and we can see here the two charts on the left and the right. The left is the market top in 2000. The market hit a new high, but most sectors were in a weakening short and long-term trend. What an absolutely fantastic chart here by Strategas versus where we are today. And that is most sectors, and by the way, ladies and gentlemen, that includes technology, are in a positive momentum with strong short-term trend, and positive short-term momentum and strong long-term trend. And this is just not emblematic of tops. In fact, the only things that are weakening are consumer staples and utilities, which, guess what? They do well during recessions. So we want to make sure that we're not getting distracted by that short-term noise. So when we look at these pictures, Tim, I get excited. I'm like, right now, I'm like, where can we go shopping? Where can we buy highly valuable merchandise like Zoom, or like if we think of Shopify, names like that, where we want to buy the dip. And that's really right now how we're approaching the current stock market correction. All right. We talked about those 10-year treasury yields. Again, just real quick here, just reiterating, we're filling that gap, ladies and gentlemen. We're overbought on the RSIs. Now, I'm going to show something here. We're not short-term traders. So this is my disclaimer. I do not, we don't try to time the day-to-day in the market. But if I was a betting man and you put a gun to my head and you said, what do you think this whole correction is going to play out here over the next couple of days, Thursday, Friday, and Monday after the weekend? Well, ladies and gentlemen, here's what I think may happen. Are you going to see this trading activity results in changes to your portfolio? Absolutely not. But this is what I think may happen. Tomorrow, we're going to open lower. It's going to be an ugly open, right? Tomorrow, in other words, being Thursday. So for those who are watching today, we probably had an ugly open today. I'm talking to you from the past right now. Kind of think of that. Where I'm talking to you from the past. I suspect that when you're watching this, you would have experienced a very weak market open. During midday, I suspect we're going to start to see buyers come into the market as we are deeply, deeply oversold. Here's what happens next. On Wednesday, we had what were called the ADP payrolls. They came in much weaker than expected, but everyone is super scared about the non-farm payroll report that is going to come out on Friday. And a lot of the times, the ADP report doesn't really accurately reflect what's taking place in the non-farm payroll report on Friday. So we are expecting, when we look at the change in payrolls, of 200,000 new jobs created. Why are 10-year yields skyrocketing right now? People are worried that that number is going to come at like 400 or 500,000. That's the fear in the back of people's minds. If we get a normal number on Friday combined with deep oversold conditions, I suspect that will be the end of this market correction. That's the playbook that I'm using in my head right now, ladies and gentlemen, that we have had this fear trade into this number. This has been the spooky ghost number for the last 2 weeks. People have seen this number approaching over the last 2 weeks and saying, oh my God, this is going to be big, which means inflation's coming back, which means we're going to get more hike rates for interest rate hikes from the Federal Reserve. Ignore all that, ladies and gentlemen. Inflation is low. The Federal Reserve is going to continue printing money and keep rates low because guess what? People are still experiencing a lot of elevated long-term unemployment. And the Federal Reserve wants to get those people back on the payrolls. So again, but that's the way we kind of see this playing out here over the next couple of days. The other reason why I suspect that this 2-day playbook may start to unfold is this. This chart right here, ladies and gentlemen, if you're going to buy cyclical assets, so like steel stocks, auto stocks, cruise liners, airliners, cinemas, if you're going to buy those types of stocks that tend to do well during when the economy accelerates and then do bad during recessions, you should have bought those stocks over here when the data looked terrible. When PMI data, manufacturing activity data, is at its worst point, in other words, 50 is your dividing line between expansion and contraction. When you see PMIs come in well below 50, we're talking like in the low 40s, the 30s, that's when you buy the airliners, the cruise liners, the steel stocks, the auto stocks. When you get to like where we're at right now, which is around 60, that's actually where we've experienced historically the worst excess returns for cyclical assets. In other words, when you get close to 60, you want to rotate out of those cyclical assets and back into more durable growth names. That's where we're at today, ladies and gentlemen. So what I would say is a deeply overbought condition in reopened stocks, oversold condition in secular growth, combined with the fact that we already had a lot of fear baked into this employment report on Friday. I suspect this is how the correction ends. I could be wrong. We're not day traders, but if you ask me where I would place my bet, that's where I would place my bet right now. And that's why, ladies and gentlemen, we focus on secular growth. We don't want to be in the business of timing these dots. We don't want to be dot timers. We want to be investors. And if you're going to be investors, if you're going to be an investor, focus on secular growth. That's where the excess return is over the very, very long term. Now, Tim, I know one question we often get from clients is, what does fundamental value upward and to the right look like? So, ladies and gentlemen, we own Zoom for fair disclosure, but we're just using this as an example of what fundamental value building upward and to the right looks like in a picture versus a stock that has not done well over the last couple of months. And what we see here, ladies and gentlemen, is the leader in the disaggregated workplace secular area of secular growth. We know for a fact the flexible workplace is here to stay. We know for a fact that companies are returning much higher returns on invested capital when they use Zoom versus when they travel and do everything in person. There's just a lot of things that we can do, audiences that we can reach virtually that we can't do in person. And we gave that example of how LifePro's been able to do that with our webinars over the last 12 months. Our best business was done over the last 12 months. And so Zoom made that possible. So what we see here is a company that sales continue to grow and accelerate upward and to the right. And by the way, ladies and gentlemen, we've had reopenings across the US over the last 6 months, some temporary shutdowns, but the countries continued to reopen and sales have accelerated versus where the stock has gone. So let me just show you where the stock has gone. Zoom has obviously gone through a correction, right? We're working off some of that rally we had in the COVID shutdown, but the reality is this gap between the prior high and where we're trading at today is the opportunity to realize that accumulation of fundamental value that continues to accrue to the firm. Now, if I change this chart to margin expansion or earnings, you're going to see the same thing. Now, let's take a look at one of these reopened stocks. Let's take a look at Macy's, right? Now, maybe I'm cherry picking, but I'm just using a random example. Macy's. Wow, what a chart, upward and to the right, right? A reopened stock has done fantastic. Let's take a look at the 5-year chart on Macy's. That's a different story. Has destroyed a lot of shareholder value. Now, let's look at the enterprise line. In other words, that fundamental line upward and to the right. Let's look at the earnings trends. So when we look at the overall earnings trends, and we're going to pull up revenue here, and then we're going to pull this back. Let's see if it actually works. Well, ladies and gentlemen, that is the problem, always doing something live every now and then. But what we can see here, oh, here we go. So what we can see here is if when we pull back the value chart, what we can see here is sales have been going down. So we started, this is just in 2019. Now, if we pull this back going a few years, you'll see even that impact even more, where sales are going from left downward to the right. And that's not a story that we want to invest in. That's a company that is losing sales, losing customers. This is the exact opposite chart of what Zoom is. And so that's why we're saying, ladies and gentlemen, that this is the type of story that ultimately is the equivalent of picking up pennies in front of a steamroller. And for us, this is just not the company or the type of company in general, whether it's Macy's, JCPenney, the cinemas. These are not the airliners. These are not the types of companies that we want to invest in. Any questions on that you're hearing from clients, Tim?
No, I think you summed it up pretty well, and really kind of demonstrated the difference, between growing that value and destroying shareholder value, right?
Absolutely.
The cyclical nature of a company that's, having less revenue than a year before, you don't necessarily want to invest in that for the long term, right? It might be a good short-term trade, but a long term, you're not going to see that value present itself.
You're absolutely correct. Ladies and gentlemen, the fundamental trend is your friend. Turnaround stories have lost people so much money over the years. And the truth is, as technology progresses and advances, let's stay focused on the leaders. We're going to have the ebbs and flows of the market, but over time, that's what's ultimately going to create value. And then lastly, sort of to wrap things up, the credit markets. Throughout this entire sort of conniption in the market, this hiccup in the market, what we've seen is that credit spreads have done absolutely nothing. And that is so important, ladies and gentlemen, because when the credit markets are stable, ultimately these are temporary corrections in the market. When you get something bigger, when you get something like 2008, where credit spreads were widening well ahead of the Lehman Brothers collapse, that's when you get really deep and damaging sell-offs. So right now, this implied credit risk indicator just remains flat. These are high yield bonds, ladies and gentlemen. These are not investment grade. These are not government bonds. These are high yield junk bonds. So the fact that credit risk remains absolutely subdued throughout this entire time period really helps us sleep well at night and allows us to approach the market in a very opportunistic way. So the bottom line message here, ladies and gentlemen, is that in order to effectively navigate stock market corrections, effectively navigating stock market corrections is ultimately, at the end of the day, what determines long-term investment success. Are you a buyer during periods of temporary weakness, or are you going to panic and are you going to step to the sidelines for a couple of weeks? I can say with absolute confidence that our clients do an absolutely fantastic job of not panicking. I will say the same for ourselves. Right now we're remaining focus on companies that over the next 5 years we believe can double in value. And that's ultimately how the only thing that we can do for clients is to offer that discipline and that guidance toward where the areas of secular growth are in the economy. And again, year over year, we remain one of the top performing strategies in the US. And I think if anything, the last week has provided just a great opportunity to put some new money to work and really kind of realize a lot of these amazing companies that are deeply on sale, because we know for a fact that the results are good. Almost every single company's reported numbers in our portfolio. So in terms of earnings risk, we don't really see a whole lot of that over the next month because everyone's reported. So that's what we have, ladies and gentlemen. We know that over the very, very short term, this period can be really scary. It was scary in late December. It was scary in November. It was scary in September. And it was certainly scary back last March. The good news is once you get through it, every single time our strategies have made new highs. And we expect, we can't guarantee, of course, but we expect this time to be no different than all the other times as our companies continue to smash the ball out of the park, they continue to deliver fantastic results, and ultimately lead positive disruptive change in the US economy, which is in year one of realizing that 1920s boom, or sorry, that 2020s boom that we think is really going to come to fruition in terms of rising productivity, accelerating economic and technological disruption, and American companies are leading and are at the forefront of this change and are going to disrupt our competitors from across the globe. There's been no better time to invest in America, and we are so excited about what happens next. Thank you again, Tim. Thank you for again attending the weekly update. And we certainly enjoy your input into this. And Tim's only going to continue to contribute more and more as we go throughout the weeks and months ahead. Thank you, everyone, and have a fantastic week.